I'm Tim Quast, and this is the Market Structure Edge, live demo discussion user group, however you want to describe it. We do this every week to help you use the platform to best effect, and we always have things to share. I'm going to begin right away here. I wanted to begin with NVIDIA. I haven't even looked to see how it's doing. So maybe one of you can tell me. I have pelted from one thing to the next today. But here's what I said I would show you. And I said, you watch, is it flows or is it fundamentals? Certainly fundamentals play a role in to the degree that they're part of a set called, a factor set called quality. You'd say, well, what about all of the discussion on CNBC and everywhere you turn? All the talk is about fundamental performance. I'm a broken record about this. Is that what drives performance? It's a contributor, but as in any ecosystem, in any market, whatever its principal purpose is, will determine the outcomes. Well, what's the principal purpose of the U.S. equity market? And you would say, well, it's for enterprising investors to find growing companies and invest so they can invest in them. I guess you could say that's the underpinning back to the buttonwood tree in 1792. But today, the principal purpose of the market is to offer products to passive investors, and in some ways to offer a betting arena. I talked about that today. There's an awful lot of that goes on. So, and if less than half of the assets in the market are buying fundamentals, it cannot possibly be true that fundamentals are reliably the indicator of how things will do. Otherwise, we just all buy the stocks with the best fundamental performance, and that would work. Well, certainly the S&P 500 is a quality data set. You have to deliver profits in the last 4 quarters to be part of the S&P 500. It's already screened for you, and it's close to 90% of market cap. But so here's what you can know about or anything. But look at NVIDIA. We can know what the flows are doing in NVIDIA all the time. This is a 1-year view. When stocks are spending a lot of time at 10, they're momentum investments. And unless and until that condition breaks down, they will deliver momentum. These are the things that we screen for in the momentum portfolio. We want to give you short-term opportunities to trade momentum. By the way, I think, Boris, if you're here, you pointed this out via email. I don't always have time to look at it. It's one of the things I would like to do is to report the results of the momentum portfolio. Certainly, we do it statistically behind the scenes, but it has done very well. Once broad sentiment stopped falling, momentum has worked well. Buying in the last 10 minutes in the day worked very well. And you could look at NVIDIA here. This is a momentum period. What happened to end it? Here's a period too. Well, once there is a weak top, you got it. Then it's probably over. And so for quite a long period here, there was no momentum. Then we had a brief flurry of momentum, no momentum, brief flurry of momentum right ahead of earnings. Now I don't know what's going to happen after this. You can certainly look back over the last year and see that there were 2 times where momentum faltered, but it never even got down to 5. Could that happen here? Well, it could. Yeah, certainly could. But it's certainly true in the data that NVIDIA has not been a momentum stock over much of the last 6 months. You could go all the way back to, October was the last time, all the way back to the summer, actually, where it ceased to be a good momentum trade. And you can always look at that and know. And you say, well, why wouldn't we just look as far back as possible? Because things change. The problem with long-term comparatives today, to me, are that they don't account for the continual fluctuation in the way that things behave. We've had a relentless pounding growth in the ETF market, $2 trillion of assets into ETFs over the last year. Investment Company Institute data. There are over 3,600 ETFs. It could be half of that is conversions from mutual funds, but it's an enormous amount of money that needs an instrument that has to track a basket. So that's going to alter behavior. But there's no question that you could look at this and conclude that barring some kind of significant change, NVIDIA is not a momentum vehicle. Again, we'll see how it goes. But you look at the supply side; it's trended up during the period where it was a strong momentum play. You could even back this up a little bit more if I, do 3 years. You can really see the supply side is less consequential than the demand side, but it certainly plays a role. And during this period where it was a very strong momentum stock, you could see that supply was very consistently under trend, Benham, and that condition has changed. Now it may revert, but I'd look at that data and say, I don't see anything here that tells me that the general conditions where momentum has diminished have changed. And of course, you can see that in the broad market. And that's what I wanted to talk about. Fundamentals versus flows. What drives the market today, because passive investors get 100% of the net inflows, is going to be flows over fundamentals. Certainly, passive money wants high quality, equities as well, but there aren't that many of them. And if you look at the demand cycle in the broad market, and I'm setting the stage for, what do you do with this information? Well, there are two things: trade short term, manage your risk longer term. That's the whole idea here. And so, if you look at the broad market, how's it doing? Well, this is the biggest drop in December. You could go all the way back to 2022 that we've had. It's not bad, but certainly it doesn't have the kind of pounding momentum that you saw back here. The first part of 2024, where we stayed, the market was very strong. We have an entry point, another chance to buy equities, stays, very strong. Little dip. That's not a great entry point, but there's a little bit of one there. And then demand begins to falter. You begin to see these periods where you have peaks, but then drawdowns, and those are things that happen in the later stages of a momentum run, a bull market. I'm not saying it's going to change and become a bear market, although I have said there is that risk, right? I think that there certainly is that risk, just looking at the direction of flows, expanding this out. And if you went back to early February of 2022, same thing happened. It's not that you have a big drop, then the market does fine. And if you have another big drop, probably we're going to have trouble. Now, I don't know when that's going to come. Certainly, it has been effective to be short the market. That has worked pretty well. I'm going to talk a little bit about trading volatility under these conditions too. And you look at the supply side, we had this big steep decline. That also happened at the beginning of the long bull market that we had, and then the end of it. Right here, this was the end of the bear market in 2022. Had the same thing happen. It's like a bookend. So while I cannot say that this condition and that condition precipitate a bear market, it's just important to watch the flows. That is the lesson. The lesson is, don't get too fixated on fundamentals, because it isn't. Do I like that? No, it's just the way it is. That flows, BlackRock, Vanguard, State Street, Geode, all those folks who dominate the top 25 holders of U.S. equities now, they follow models. They're going to follow models, deploy capital based on an outcome. You look at NVIDIA, it's in the same number of volatility hedged ETFs as it is tech ETFs, 74 of each. So it is as much a volatility play as it is an investment in tech. And that's important to know. Those are equal motivations. And so one just has to keep these things in mind. Another thing I mentioned that I would explain very briefly, is unrelated to this, but is I said, that more than half of volume in the equity market is in alternative trading systems called dark pools. Let me see if I could even find this for you. Let's see. If you go to, you can do this yourself, SIBO volume summary. You can tell I look that up routinely. It's a great way to see this condition. And the reason this matters, is I'm having to do that here. I don't know, Henry, maybe you're doing it. So if you are, thank you. You can see the entire market here. And this is today. And if you hit these little pluses, you can see, NYSE has 5 exchanges, the NASDAQ has 3, SIBO has 4, then these are the independents. Add those up, I think it's 16 of them. And today, they only have 46% of the volume. 54% is occurring in broker-operated dark pools. And and I want you to understand what that is. All of it rolls up to the tape. We're not missing any volume. But out here in the trade reporting facilities, that's what that stands for. The NASDAQ runs what's called the Securities Information Processor. Those things are occurring at prices generally between the bid and the offer somewhere, some derivation of midpoint at some broker-operated pool. And I showed you those last week where you could go to, I think it's ats.finra.org, and you can see all of this data. It'll be a couple of weeks delayed, but it's there. And why does that matter? Why is it that so much volume is ending up in dark pools? Because so much of the money wants a midpoint. It's not picking stocks. It needs an amount of a product, and it needs a stable price. And so that's what happens. And so then when companies report earnings and bounce all over the place, that is a product of bets. It's not rational behavior. It is directional bets. You have to be aware of those things. Just like we talk about demand, supply, and volatility as the triumvirate of good trading decisions, there are bets, flows, and fundamentals, but fundamentals is the smallest. Okay, now that will dovetail into one other thing that I wanted to mention. I try to answer these questions. I said, that Citadel moving into cryptocurrencies might not be good for equities. And I simply mean that firms like Citadel are over half of all volume, and it's because of what's occurring in the market. And I'll get from the education to the practical application here, but I just think these are important things to know. When you look at your dashboard, there is a tremendous concentration in large caps, and there is an explosion of ETFs. There are, how many are there? There are 3 million global index products. There are daily options, weekly options, month-end options. There are futures contracts for difference, swaps, all that kind of stuff that all leads back to where is the market cap? Well, 90% of it is in about 500 stocks, give or take. It depends on how you calibrate what total market cap is. But if you look at this list, and if total market cap is 65, 63, I don't know, trillion. And you look at and you dump this data for mega caps, 118 companies, into Excel and tally it, it's 70% of market cap. All of those things tie back to them. That's the problem. And so Citadel and Jane Street and so on they're making markets in these things, keeping them together. If there's an ETF that has a basket of stocks, when the basket of stocks is more valuable than the ETF, then they short the basket of stocks and buy the ETF until the reverse happens. You can see that market wide. But that condition prevails. If Citadel now directs more of its resources to something else, will that show up in equities? I don't know, but it's something to keep in mind. And look at this supply-demand balance. You look at the supply side here, which is starting to tick up. It actually moved up fairly materially yesterday. This is an average, so we're calculating an average. If you took the volatile elements and you smooth them, we've seen a turn. So that's the equity side. That's the basket. Now let's go look at the tracker. You can see this stuff. SPY is the ETF. What's happening in the ETF? The ETF has really massive short covering. This is taking supply out of the market. So that can mean two things. There's the arbitrage basket where Citadel is now covering the ETF and beginning to short the basket. That's certainly part of it. And when people are removing money from the market, then authorized participants have to take a supply of ETFs out of the market and supply them to BlackRock or whomever, who give them a basket of stocks, which they know is coming. So you would expect to see a rise in short volume, and then they get rid of them. The whole point is to buy low and sell high. And that's how that whole mechanism works, which will lead us around to where the market is going to go next. Now, I want to get to some mechanics too here. You with me on that? Now, I don't know what's going to happen, but I certainly can look at where broad market sentiment is and say it could be topped again. And what happens tomorrow? Month-end options expirations. Look across your dashboard now, and you, by the way, you can always go compare this. You could say, let's look at communication services, 30-day view of demand and supply. The supply side has steadily trended down. The demand side, fairly consistent. You look in since options expirations, it is trending down, and the supply side is trending up. So from a very short-term perspective, you would look at that and say, that is something you would short, all other things being equal. Don't get run over by options expirations, earnings, or broad sentiment, but broad sentiment might be doing the same thing. So then you could go out and look at the sectors, right? You could go do this. Here, State Street Spider sectors. And you could say, well, let's look at the last month and look at communication services. I don't know how it said. We'll just see it here. It's up some, but not much. Shows exactly what the data indicate, right? Not bad, but not great. And so, if you look at the whole over the month, S&P 500 down a little bit, consumer discretionary down, industrials down, tech down. Go back and look at your dashboard. Let's go look at those. Consumer discretionary. They're big short into options expirations. Everybody covered at options expirations. Same trend developing, and it's right at 5. It's not great. It's not terrible, but it's not good, right? It's not good. Industrials. Again, the supply side isn't bad. The demand side is just not good. It can't get above 5. If it doesn't get above 5, over time, that's going to deteriorate. Tech, tech to me is a source of concern. Same thing that we see in communication services. The demand side is deteriorating, the supply side is rising. So then you say, well, how is the market doing as well as it's doing? Well, you look at big tech or mega caps, they're holding in there above 5, and supply has really tailed off. That's where the basket is. Big tech, kind of the same way. I mean, it's not good, but look at the supply side. Those two things have run counter to many of the other things that you see, which explains why the market does what it does. It diverges, the Dow goes up, other things go down, and vice versa. It is very much a principle of this and volatility. So from a mechanics standpoint, what do you do? If you're going to trade momentum, and demand has been rising. Candace, as I said last time, if demand is falling in the broad market, I don't want to hold over a weekend, and I'm a little more careful about buying in the last 10 minutes of the day. But we've had a pretty good stretch here, and these stocks have done extraordinarily well. I mean, you could go back and look at how well these momentum stocks have done. Buy in the last 10 minutes. In more than half of them, you're immediately out at the open the next day as the market pops, and there's your return. And you've risked your capital overnight. Yes, that's a risk. But in terms of exposure to the market, about 11 or 12 minutes. That's not the thing that you're going to do all the time. But when these conditions exist, you can use them to your advantage. But I wanted to talk about volatility really quickly, because it's been pretty easy to trade this. When the market does not have a clear direction, you could do, and I'm not advocating this, I'm making an observation. We don't give advice, and I won't even, I will tell you this is a risky thing to do, and you should be fairly confident with what you're doing, and you should do it on a small scale. But when demand is just can't seem, for what is that? 5 or 6 weeks now, we have had a hard time finding any direction in the market. And the supply side has crept up, except for this about 8-day period where it declined, gave us these gains in the market. With options expirations, they immediately vanished. I don't think people renewed their options. But you could trade volatility. So you could almost count on it, right? That if an instrument like UVIX is down because the market is way up before the open and it just sits there, and UVX is way down, it's almost like clockwork that you can make 5 or better percent on that thing. And as soon as you have, you take that and then it reverts. Or if the market starts the day way down, has a propensity to recover. Those things are opportunities that you can take advantage of when you know that the supply demand equation isn't giving a clear direction that will necessarily produce that very consequence in the behavior of the market. Okay, other than what's ahead, I have sort of, Henry, are you there? Just making sure that you are. I'm going to stop sharing for a moment. If not, you're stuck with me. I guess you're stuck with me. Questions? I haven't been able to look at it. Let me look at the chat. And fire away if you'd like. What happened to Amex? Let's take a little bit. Candace, thank you. I hadn't had a chance to look. I'm not surprised by that, right? That you could look at the supply-demand equation in NVIDIA and say, well, I certainly wouldn't buy it. I mean, people weren't sure what was going to happen. We'll look at Amex too. Hang on, I've got to refresh that. Okay, here's what I mean. If you were looking at this yesterday, so this would be where it was. You would look at this and say, well, there's down here some covering, pretty sharp covering.
Yeah.
But
Jim, you're not sharing your screen. You're not sharing your screen.
Thank you for telling me. I appreciate that. Yeah, I see that now. Thank you very much. It's harder without a sidekick.
You're doing great.
Appreciate that. Okay, so here's what I mean. So the day before NVIDIA reported, here's what you would see. Pretty good demand stretch here, but tailing off. You look at the supply side, some pretty good covering because people don't know. But all of this ahead of time, it tells you there was a lot of straddling. And I'd look at this and say, well, I'm certainly not buying it. I don't know what direction it's going to go because if the bets one direction or the other are so large that they overwhelm the demand supply equation, it's the derivatives are implied but not realized demand, and so it can vanish from this equation. We have a very good indication, but not a perfect one. And around earnings, you just never know. But I'd certainly look at this and say, I wouldn't buy that. Because supply is still well over 50% and demand is coming down. Mathematically, the probability is a decline. Doesn't mean it's gonna. The probabilities around earnings are challenging. Okay, so then Amex, AXP, right? Is that right? Yeah. Okay, let's see what happened here. And I don't know what happened today with it. Was it way up or way down? But you can look at this and say, the big things that stand out: very weak demand and supply that has trended up and is pushing close to 60%. So again, mathematically, you would look at that and say, well, I'm not going to bet on that. Contrast that with rather a daily trading ideas member of the momentum portfolio. SMCI finally getting out of its regulatory mess on the last possible day. Would you buy that? I don't like this, but the fact that it tailed way off and has huge demand probably means you can capture a pop. And there's the difference, right? There's that strong difference. We look for more than 1.5 standard deviations in that. So one of the criteria in there. So you have a sharp divergence between the two, and that's what does it. Mechanically, I'll say again, what I prefer when broad sentiment is rising. Broad sentiment has been rising since options expirations. Barely, but creeping its way up. Last 10 minutes, get the reference price. You're going to benefit from whatever the flows are. It's going to come heavily from model driven asset allocation, passive investment behavior. And the next day during market hours, machines start over with whatever the demand supply balance is, in some part informed by global electronic trading, which is occurring in 24 hours a day. So then you have a much better chance. If demand is falling, I'm going to be much more careful about that. There may be opportunities during the day where the market will have a propensity to stop rising. So then maybe stocks are down at the open and you have a chance to buy at the lower end of the entry range, and then make sure that you're out close to the close. That's all modulated by what the overall flow trend is in the marketplace. Okay. Before I get to what's ahead, questions, comments, observations?
Yeah, got a question. It's very interesting and educational that the flow is playing such an important role. Now, we've been discussing a lot about the elements within the equity market, which is influencing the flow, which is the options exploration and all those things. Now, what are the elements outside the equity market? I'm interested to learn what is the effect of the bond market over the equities. There's a huge forex, but I think that affects dollar, that affects too. But bond market has been influencing the flow into equities more directly, perhaps, from an external element. Within the system itself, everything that you're saying is excellent. I would like to learn a little bit about that effect.
So my short answer to that is that every motivation manifests in demand and supply. So those things are inputs. They're going to manifest somewhere because demand is we say demand is a manifestation of buying and selling under rules 605 and 606, trade execution data. And can we get to absolutely all of it? No, we have to model part of it, but it's a reflection of 100% of the money or the volume. And so some part of that, it is a very good point. It's like what happened today, where there were a bunch of data points on, the PCE, personal consumption expenditure, that the Fed likes, consumer spending, jobless claims. These are all things that, like Aladdin from BlackRock, I don't know the precise number, call it $20 trillion of assets use Aladdin as a risk management system, and it's absolutely consuming signals from the bond. They're a huge fixed income manager. There are bond inputs. There are currency inputs. The strength or weakness of the dollar, clearly an input. All those data points could be called global macro data points that are inputs into these models. So do we need to factor for them? Well, what I come back to is all of it is demand and supply. To the degree that hedge funds use it, it will be long short. To the degree that long only money, which most passive money is too, then it's going to manifest principally in demand. But then market makers like Citadel, who engage in bona fide market making and are exempt from having to locate shares to short, are going to react to supply demand fluctuations, and it can manifest in supply. So, is there some confirmation bias? Perhaps, but my belief is all of those inputs factor in. And I think the flatness of the lines everywhere tells us how difficult it has been for these global macro risk management systems to figure out what to do. And it has been, I won't say it's been difficult to make money. It has been difficult to know what the market's going to do next. But that would be my response, Benham.
Right. Thank
you. Shall we look ahead? And anything else you want to observe, please feel free to do. I like to just look at all of these. Consumer discretionary, reflection of the consumer. Don't like that. Consumer staples, it's pretty good, actually. But supply side is ticking up. Dow Jones, I think it's had a pretty good day today. But I look at this and say it is reflection of the bias toward low volatility. That we need things that will protect us from violent moves in the market, and it forces money into things that have less volatility than the average S&P 500 component, which is, believe it or not, it's up to 2.7%. It's way out of bounds. It's getting very difficult if you're an index investor to track your basket. And I think that's forcing money into lower volatility stocks. And that necessarily shifts it away from tech, which tends to be much more volatile. You look at big financials. Those don't look, it's good covering, but there's no demand for them. Gold, which has been awesome. We may get a buying opportunity in gold looking at that, right? It's not that it's going to fall much more, but certainly the demand has diminished. Healthcare. Healthcare has been the best performer of 2025. And Could you have seen that? I don't know. I look at this and say I wouldn't have known, but I did highlight it. I'd highlighted it early in the week that if you looked at the supply demand divergence, from options expirations to present, demand's rising, supply fell sharply. That's over. So it's predicting that, as we get into month-end options expirations and into March, probably you don't want to be long healthcare anymore if you are. And you look across the rest of it, I am hard pressed once again to find something that I would want to be in other than momentum. If demand is rising, and I think it's going to peak, I do. I mean, technically on a volatile daily read, it peaked today. Now that can change. Depends on, that read is 5 things. It's 4 behaviors and the rolling 5-day average of performance of midpoint price. Because the demographics all affect price. It could be a bunch of machines, could be derivatives. Derivatives tomorrow are going to be a factor. And then into early March. If money doesn't show up, new month, new money, I don't know what's going to happen. I just look at the data and take it as it comes. Real estate, doesn't look great. Retailers, SaaS, which has done really well, not the place to be now. I said maybe semiconductors would benefit. They did from some short covering, but even that I would say is over. Small caps,
yep.
Don't look good. Total market doesn't look good. It's not a good read. But I look at all this and say the only thing you might want to be in is utilities. Looking ahead, what I would say is we are we are right at that dividing line where the bottom could fall out. I'm not saying it's gonna. None of these indicators say so. It's just that you can only go so long arbitraging the basket versus the ETFs until something's got to give. And we're in those conditions where it could. But generally speaking, you have to keep your horizons short. I am not committing I've got money to put to work in equities and I'm sitting on it. And anybody who asks me, says, should I put this money into, I'll say, no, don't do it now. Now you don't want to plow money into the equity market here when you don't know what's coming next and it's rising and it's nearer the red line than it is the green line. I much rather put money to work when demand is below the green line. Then you get a return from it. And so that's certainly the way to think about it long term. Short term, we're getting to this point again where I may stop buying, in the last 10 minutes. Barry Norton, please.
Hello. Tim,
Hello.
I'm good. Can you give me a definition between a divergence of 1 and a divergence of 5? I just want to refresh your definition.
Yeah. To me, a divergence of 1 isn't enough to matter. Somewhere between 1 and 5 is what you want. I mean,
what is the value of that? Is there a certain standard deviation or something, or what is the value between a 1 and a 5?
It's a standard deviation. That's what it is. So it's 1 to 5 standard deviations. Yeah. Yep.
Okay. So it's a 3 is a 3 deviation then?
Yes, it's a 3 deviation, 3 standard deviations. And you might say, well, wow, that's extraordinary. It's a very volatile data set, right?
Yeah,
demand and supply are very volatile, as are prices. Prices are extremely volatile. And so it might seem incongruous that you could have that much deviation. But I mean, I think if you're, what Barry's talking about, if you create a portfolio, you can use standard deviation as a metric. I don't know if you can find any 5s, right? That's so extreme. But what we're talking about
I've played around with it. Yeah, okay. I just want to get your clarity on that. Perfect.
Yep. What we're talking about is the difference between this and this. That is, on average, that is more than 1.5 standard deviations. And why is that important? Well, statistically, we found it to be. I can't say it's more than that. We found that was statistically meaningful. I can tell you mechanically why it is. I mean, if you have a surge in demand and it's out of step for whatever reason, why does this plunge? This is taking an average of the portfolio. Why does this plunge? Well, it could be for multiple reasons. You could have people who are short the stock who are covering because the stock's rising and they're on the wrong side of the trade. That's actually a very small part of the equation. Call it less than 10% of it. There are classic shorts who are betting, like you, Barry, that will say, I'm going to borrow this stock and sell it on the belief that I can buy it back later at a lower price and pay my borrowing costs and profit. And that is not that common. Hedge funds play a big role. The hedge funds that are long short, like Citadel runs 50-50. 0.72, I know they told me this, right? I know people at the highest ranks in those organizations, and they could change. But they're 47% long, 53% short, 0.72. This was a little while ago. There is market making. That's a huge part of it. That is the bulk of it. Hedge funds and market making. Well, they know a lot, right? They're the most informed. And so those things all contribute. I think a lot of this is market makers saying that thing's going to move and I don't want to have this liability. So they immediately cover, their horizons are very short. And that gives us opportunity, right? We're right in demand and an absence of supply, and that will move price. Not perfectly, just very, very statistically, predictably so. Okay, cool, that is enough to drive everyone to drinking. Right? I have a happy hour today, but I'm trying to get into boat shape. So I'm almost not drinking anything at all these days, but which is probably good for me, Well, it's very good to see everybody. We'll do it again early March. We'll see where we are. And as ever, send me a note at any time. You're struggling with something, TQ at Market Structure Edge. Might take me a couple of days, but I will always get to you. And, we always appreciate you all. Did I answer all the questions? David, what is going on when you see very low supply rounds? That's a good question. I'll answer that really quickly, David. So there are two things that are going on. Number one, there isn't enough market making in stocks like that. And often that's the case. That whatever, Citadel, I use Citadel as an example, it's a type. That they're not showing in their models reason enough to make a liquid market in a stock like that. Number two, deal stocks often manifest that. It's one of the core things we look. It doesn't mean that half the market's deal stocks, at whatever many there are like that, you could screen for it. But we look at it all the time. You could go look at Nevro being bought by Globus Medical. Go look at what happened when the deal was announced. I mean, you don't even have to know when it was. Just look at the short side in Nevro and you'll see it right away, NVRO. It's one of the core things we track. That can be a reason. So those to us are the big two reasons. You say, well, why wouldn't we just all buy 25% short stocks because they're bound to go up? Not true. Given the market making system that we have, given the paucity of liquidity, the market absolutely depends on those levels. You need a level of 40 to 50% in any given stock to get in and out of it efficiently. There's got to be somebody there who will cross the spread. Do I like that system? I think it's a terrible system, but it's the one we have. What was happened is with it, the market was turned over to intermediaries so that there would always be 100 shares at the bid and the offer. As I said, the SEC decreed that the single most important thing to the U.S. equity market is a continuous auction, one that never fails. And so in order for that to be true, the SEC gave to high-frequency traders, market makers, automated market makers, the opportunity to make money on nearly every trade. And they're going to take a tenth of a penny. And what we get in exchange for that is good execution and markets that generally find their footing pretty well. I don't like it. I have inveighed against this market, but it is important. So David, you can't just go, I'm just going to go screen for 20 stocks with 25% short volume and buy them. I mean, if you're a deal arb, it would be something you should look at, but that's it. Mike Green, are you the Mike Green? This is the celebrity. So if this is Mike Green, Mike, it's good to see you. By the way, I might be in New York the week after next, and I'll if you're there, I'll look you up. Do you have examples of stocks? It is you. Yeah. Thank you for showing up at our gathering. It's good of you.
Always a pleasure. I think the stuff you do is really interesting, very complimentary to my work.
Mike is a principal at Simplify Asset Management, an extremely smart fellow who has done some remarkable work on the mechanics of the market, and like me, has attempted to educate public companies on the importance of understanding how this market works and to recognize the public companies waste a lot of time trying to pursue an audience that is a net seller. But anyway, extreme supply demand imbalances. We screen for them. Absolutely. On the fly, you could go, as Barry Norton was saying, give me stocks with 4 standard deviations between demand and supply. That's a pretty good way to do it. I don't know what we'd find. We could go do that really quickly. And I'm sorry to keep you guys. Oops, wrong one. So if we went
and I
said,
apologize. I actually am going to have to drop off in like a second, but I'd love to see an example of something that you're seeing there.
I'll send it to you, Mike. Yeah.
Perfect.
I try to
Thank
wrap
you so
these
much.
things at 1:10 Mountain Time, but I often fail.
Oh, I apologize for interrupting everybody else. Thank you
No,
again.
it's good.
I look forward to chatting with you.
Good to see you, my friend.
All right. Take care.
You too. Okay, and I'll just finish this. So if we go look at, let's see here. Supply demand divergence is what Barry is talking about. And let's just do this really quickly. Equal to 4, which is extreme, right? And I'm not sharing my screen anymore, I don't think, right? Let's see what we found. None. Yeah, you can't even find any with 4 standard deviations of divergence at present. And that makes sense. You look at the market right now and how flat all those lines are, we are going to be hard pressed to find extreme divergences. Didn't find any at 3. I didn't find any at 2. Did you? Maybe I've got, I think that's right. It's very difficult to find them beyond 1.5 right now. Yeah. That's one criteria, right? Candace, yeah, what you got? We'll make you the last question.
Hello, I had a question earlier about what makes a stock jump or fall drastically overnight. Because I saw this the other day, about 2 nights ago with ASTS. I was about to go in the night before, and then I checked if there was options expirations, no earnings, and then it jumped like 7%.
You're like, doggone
and so I'm just trying to get the picture of what I'm missing here, because I see it happen a lot.
The answer is there are 3 things cause it. There's global electronic trading. There are 220 markets globally-ish where equities can be traded electronically all the time. So you combine that with the presence of derivatives, which you can buy anytime. I mean, they're over the counter. Half the market is over the counter for half of the options market trades over the counter with brokers. Meaning, if you were a large trader, you could go to Goldman Sachs and say, "I want to make a 50,000 option bet on X stock," and put up collateral, and they will execute that trade. Well, you move the whole market. You just move the whole market. So that happens, and the way that machines respond to any bit of information. I mean, the market is incredibly robotic. It was in 2010 when we had the flash crash. I wrote about this in the weekly blog this week. So those things are responsible. And a large part of that is hedge funds that will bet outside market hours and do it with their broker. It's almost like the show Billions, where you see these guys working in the middle of the night and they're like, "Get on the phone and dump it," right? So you say, well, how do you do that? Well, if you're big like that, you've got multiple prime brokers who will take the other side of the trade, and they will immediately dump whatever there is. And big brokers can dump it into those global markets anytime. And so then your position gets destroyed, or in this case, there's electronic trading occurring, and someone picks up that there's a big options bet, and the stock soars. So you were correct, right? You were correct, but that's the challenge. Sometimes those things happen, and those are the causes for those big moves.
So it's not necessarily when these dark pools are actually hitting the roster, or
Well, it certainly could be. Absolutely.
Okay.
So the trading in those facilities, there are no display prices. There are prices at the exchanges only during market hours. During the rest of the time, unless a facility chooses to display prices, there are a couple of facilities that will do that. There are no displayed prices. But if I'm sweeping through, I'm running algorithms, looking at that particular stock, and I hit a market, an over-the-counter market like Goldman Sachs's or Merrill Lynch's or whomever's, and all of a sudden you see that the prices are moving, there's your tell, right? Now somebody over the counter has bought a position, or you might be tricked, but that's what happens. And yes, that can happen all the time. I have argued that is as an unfair advantage for large institutional investors. I mean, why is it that they can do things like that outside market hours? We can, but I don't know if you've tried. It's very difficult to fill trades outside market hours. You have to just hit it just right. And that's the reason. We are at a distinct disadvantage there.